Okay, this one hopefully should be a bit of fun. Retirement tax tips that get increasingly more valuable as I go along the video. Just to be clear, while these are general planning tips, they're not a substitute for advice specific to you. And with anything tax planning, there are exceptions to the rules that I can't cover. So as always, if in doubt, please get professional advice specific to you. And that's enough covering for one day. I'm also going to, in this example, give you an estimated value of how much it could potentially be worth if used effectively, but it is just an educated guess and it will keep things going. So let's set the timer off and here we go. Okay, first up is spousal contributions. Okay, so for couples, it's often worth considering maximizing tax relief at the higher rate for each individual if we can, before paying contributions that will only secure basic rate relief, because look, 40% or 45% is better than 20%. So how this works is that, assuming they're a UK relevant individual, you can make a contribution of £2,880, which gets grossed up to £3,600 after tax relief, as long as it's a relief at source scheme. Why might that be worth considering? Well, look, if you've potentially got one spouse who maybe has no income or they've got a full personal allowance, what you could potentially do is you could make continual contributions of that £2,880, which gets that tax relief applied to £3,600. And here's where the advantage comes in. Well, if they've got their full personal allowance or some of it, then if they do start drawing on that at a later date, it could be the case that they've basically got tax relief coming in, but then it comes through tax-free on the way out because they're extracting it within the personal allowance and with some tax-free cash. I do have to highlight that if you do that, when withdrawals are taken, you are going to trigger what's called the money purchase annual allowance, which means that future contributions are going to be limited at the current point to £10,000 per year under this legislation. However, this is on the assumption that if they don't really have any other income or pensions, so I can't imagine that £10,000 allowance is going to be too much of an issue, but it's worth considering. How much might this be worth? Well, look, $720 in tax relief. Let's say they've done it for 5 years, and it's extracted tax-free, giving £3,600 in tax relief by that strategy. Okay, next one, a mixture of income and tax-free cash. Okay, this is a bit harder to quantify the value because it depends on individual circumstances, but it's a retirement income technique. And what Flexi Access Drawdown allows is that some withdrawals can be taken as part taxable income as part tax-free cash. Now, many withdrawals will just typically be 75% taxable income and 25% tax-free cash. However, some providers do allow income withdrawals to be taken in different proportions. So it is possible for a withdrawal to be made up with a higher proportion of tax-free cash, provided that there are sufficient uncrystallised funds available. And that actually means that a smaller amount can be down as taxable income. So what actually happens here is the crystallised element that isn't taken would typically stay in the pension as a crystallised fund. And yes, it would be taxable at a later date, but spreading out how you take tax-free cash and income across retirement can supplement income. It can make sure that you stay under, for example, 40% tax rates. It can also be the added bonus that the funds that are left within the pension are left in a very tax-efficient position because any growth is free of income tax and capital gains, and the pension pot can remain outside the estate typically for inheritance tax. So let's say you have $45,000 in defined benefit income and you need $50,000 per year. And you've maybe got some flexible pensions in the background worth $200,000, which provide $50,000 in tax-free cash. While, of course, if you just wanted everything to come tax-free, you could just take the $50,000 out immediately rather than draw down on the cash. But the downside of that is it's now outside of the pension as far as tax efficiency. And with the personal allowance for saving at £1,000 for basic rate taxpayers, if you've got £50,000 at a 2% interest rate, you're already going to get taxed on additional cash income. Now, if you phased, so took out chunks of tax-free cash, then it could be the case this could be spread out for a decade, maybe even longer, depending on growth, inflation, or the rest of it. This technique works specifically really well when you're using it, for example, in line with personal allowances and then topping up the residual income from tax-free cash, so it all comes through tax-free. And it's really genuinely difficult to put a pounds and pence on this one because it depends on circumstances. So I'm going to say, look, if you've got a tax-free cash of 100 grand, you could probably get a good 5 to 10 grand of tax efficiency here over time with some assumptions. Okay, next one. Sacrificing a bonus for an employer pension contribution. And this one's maybe just to ask your employer about, depending on your bonus structure, but because the tax year end can often coincide with the business tax year end, it can mean that for some employees, actually sacrificing or exchanging a bonus for an employer pension contribution can bring about quite a few tax benefits. The employer and employee national insurance savings could be used to boost pension funding if your employer is going to be generous enough to do that, giving more in the pension pot for every pound lost in take-home pay. The thing you need to check is, look, the size of the bonus, your annual allowance available, maybe your carry forward available, and obviously does the employer allow you to sacrifice the contribution, and maybe even their willingness to share the national insurance savings. Anyway, this can be a really efficient way, especially on the build up to retirement, to getting a bit more money in the pension and reducing your tax burden. Let's say you're in a position where you sacrifice £10,000 every year for the 5 years before retirement, and you would have paid 40% income tax and 2% national insurance. Each year, you would have had a tax saving of £4,200. So if we times it by 5, that's £21,000. Now, you may clearly and fairly say, but look, George, there's going to be tax on the other end. And you're right, but bear with me, so that's going to come up. Okay, next is avoiding the 60% tax trap. Okay, how does 60% tax rate work in the UK? Well, look, there are actually figures from the Telegraph which showed that nearly 1 million more workers paid income tax at the 60% rate. And how it works is that for workers in England and Wales, anything between 100,000 and 125,140 will fall into the 60% tax trap. And the reason why is because there's what's called the personal allowance, which is £12,570 this year. Once you've gone above the personal allowance, then it's 20% basic rate and then 40 and 45%. This weird position in the tax system, which personally I think you should get rid of, is that once you earn over 100 grand, you actually start also losing your personal allowance. And it's £1 of allowance for every £2 you earn above 100,000 as far as taxable income. That's because basically two things kick in. Your income tax rises, but also you start to lose your personal allowance. Now, we can get round this by making a pension contribution. And there are different ways to make a pension contribution, potentially by salary sacrifice, but let's just assume it's a private pension contribution through relief at source. You will still receive 60% tax relief if you're within those ranges. But what happens is that 20% of your net contribution will be automatically grossed up by HMRC, and that will go into your pension. Then as a higher rate taxpayer, you can also claim back an additional 20% on your self-assessment form, which when factored in can also reinstate your personal allowance, which gives you that 60% tax relief. Let's say you've got an example of someone who's just received a pay rise. And once the current employer contributions are deducted, the income is exactly 125,100. And maybe let's say they go, sack this, I don't want to pay 60% in tax. Well, what they could potentially do on that 25,140 is that you could maybe make a personal pension contribution. And let's just assume it's done by the individual, so it's already come through after tax. Now, this personal pension contribution will reduce what's called their adjusted net income, which is one of the key technical things which actually reduces the personal allowance. So before the contribution, I'm just going to put the figures on the side here. You can see the annual earning, income tax and so forth, and then you've got after the contributions, where of course you're going to have a lower take home pay because you are still sacrificing. But what you've exchanged is actually also that additional contribution to the pension, which is at the end of the day is your money at a later stage. And the income tax savings are here, which are really sizable. So if we just factor in that additional pension contribution compared to the income tax saving, you can see how beneficial it's worth considering, especially as you are effectively funding your future self. And remember, and here's the crucial thing, when you come to retire, for the vast majority of us, assuming you don't have other things like buy-to-let incomes, you're probably going to have your personal allowance, you're going to have less income because most retirees don't have quite as much as income. So how much is this worth? Well, in this example, I'm going to say you get 60% tax relief and I'm going to say you extract at 15% or less. That's a 45% tax arbitrage. So how much is that actually going to worth? Well, if you were to regularly do that and you were going to fall into those bands. Before I go into the next section, why not please consider subscribing to the channel? I've got a ton of videos here on personal finance, retirement planning and making good decisions. And let's be honest, right now, it's kind of an area you need to keep on top of. Okay, so next up is just generally retirement tax arbitrage, which is that, look, in the UK, taking advantage of higher rate relief when you can, and then drawing from your pension when you retire at a lower tax rate is one of the most effective retirement strategies out there. As an individual, it's possible to get tax relief at a rate which is at a higher rate, 40 or 45%. And by maximizing this when your earnings are at that level and taking advantage of the fact that you'll be drawing down at a lower amount in retirement, you get that benefit. So part of it is just strategically planning and structuring pension contributions on the build-up so that you're maximizing that. And then when you come to retire, doing everything you can to reduce the tax liability. So something I'm always saying to my clients, I'm saying, okay, look, we have an opportunity for maybe 40, 45, or even 60% tax relief. Let's say you're drawing at 50 grand from the pension, it's your only source of income. We've got your personal allowance of 12,570. You've got your basic rate of 50,270. But remember, under the rules, you also get 25% of your pension pot as tax-free cash. So look, if we were to say you just took 50,000 gross withdrawal, this would be your tax rate, which is much, much lower than the 40 or 45 or 60% tax relief you've got. So I think if you're a higher earner, of course, I think it's very possible to eke out 10 grand tax saving per year on that arbitrage if you contribute sufficiently and you're aware of this. So I'm going to say, again, like I did last time, 5 years, 50 grand in tax savings by doing this effectively. Okay, next one, potentially one of the biggest, but one that some people may not care about. This one is all about legacy planning and making sure the death benefits are set up correctly for your pension. So the first thing you need to understand for your schemes is the potential list of death benefits for any pension. So it's important that you check what apply to your particular schemes, especially for older schemes, because they may not have a full list of options and there may be some restrictions. Now, this is specifically for money purchase schemes, all this list, because defined benefit schemes are typically set by the scheme. So it'll be like a spousal pension and maybe a guarantee period. And I also want to say that just because the death benefits are restricted, that does not necessarily mean transfer the benefits, because there may be valuable things like guaranteed annuity rates or bonus attaching. But it's definitely important to be informed and aware of what your options are. So I'm just going to put on the screen a selection of death benefits. And it may just be the case that all your options for an older scheme are, say, an annuity, which is just a guaranteed income that would pay for your dependents for the rest of your life. It may also be possible to gain access to drawdown, so the pension can effectively pass to your dependents and then on to that for successors within the pension wrapper, and maintaining all the benefits of the features of a pension so that the investments can grow free of income tax and capital gains. Now, for some older policies, the only option may be a lump sum, where if you pass away, a lump sum is typically paid to whoever is listed on the nomination of beneficiary, which is a form that you provide to the trustees to indicate who you'd like your benefits to be paid to. The thing that's really specifically important in relation to this is, in line with the most recent changes with the abolishment of the lifetime allowance, there is now what's called a lump sum death benefit allowance. And if you exceed that lump sum death benefit allowance, any benefits above that are taxable at the recipient's marginal rate if paid out as a lump sum, because there is tax levied to lump sums. Whereas pensions allocated to drawdown, it is possible to effectively move it to a drawdown wrapper and avoid that potential lump sum charge. So let's just go through a very simple example, which is very much possible, but again, as I've always keen to stress, isn't indicative of your situation, and please do get advice specific to you if you're in doubt. Let's say we've got an individual who has a £2 million pension, they pass away, and the only option, because they didn't check the scheme, was for it to pay out as a lump sum. They had no form of lifetime allowance protections, so their lump sum death benefit allowance is £1,073,100. And because their scheme didn't allow designation to draw down, that means the recipient has everything between $2 million and $1,073,100 taxable at their marginal rate in the year. And when you're at that point, there are only really limited options available as far as reducing that tax burden. So even if we assume that the recipient had no other income for that year, that $926,900 would suffer a 43% tax rate, or more precise, about £403,000 tax payable. If the policy had more flexible options, that fund potentially could have been allocated to drawdown and maybe even avoided that level of tax entirely. So I know that's an exaggerated example, but it just shows the importance of proper tax planning and also just really checking the details. So how much is that worth? Well, 400 grand. Isn't that wild, just from an administrative thing? And as an advisor, you do come across this stuff every so often. So I hope that was useful and give you some things to think about. See you next time.